Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, November 21st, 2023. Welcome back to the podcast, George.
Hi, John. Great to be back on, as always.
Yeah, good to have you, and a early happy Thanksgiving. So we are
and to you as well.
Oh, thank you very much. So for our listeners' benefit, we're recording this podcast really after the market's done a total 180 since I think our last episode. The 10-year Treasury I think has rallied something like 50 basis points. Financial conditions have eased off the tights significantly, really unwinding quite a bit of the financial conditions easing that we've seen really pretty much. I mean, certainly in the third quarter, but it kind of throughout the entire year. Stocks are up a lot. Mortgage spreads are way in off the wides. Credit spreads are in. So it's just a stark difference in terms of a backdrop for the episode, if you will. But the market's built on the narrative that the Fed is done. The war against inflation has been won. There's been some soft data releases along the way to reinforce that narrative. Seems like a majority of the market participants are really buying into this expectation that the U.S. economy will achieve a soft landing. I'm obviously aware that you do not share that view, and so that's at the very least not your base case. Why don't you walk us through how we got here, and how your view has evolved, if at all, and how you're seeing things in the near term?
No, absolutely, John. It's been a rip-roaring, risk-on rally, and a lot of it on the back of a decent decline in rates, largely unwinding almost half of the big rise that we saw in the belly intermediate part of the curve from the summer when we started getting concerned around the fiscal outlook and debt and deficits. So it's clearly been a big switch, as you suggest, and this really started at the beginning of the month, and so November has really been like a stark contrast for the prior few weeks heading into November from October, where you had actually some risk-off and concerns about assets. We saw a complete flip, especially once we got past the Fed. And look, as our listeners and those that follow our work will remember, this was the risk. The risk is that very thinly traded markets coming towards the end of the year, if the narrative and the catalyst change enough, it can exacerbate the moves in all these different asset classes. So I think a lot of this is really just position relating, flow related, just markets getting thinner as the year end approaches. So I think that's one part of it. But there is, the catalyst. You had the Fed, which once again skipped and did not hike in November. And from November 1st on till now, which today, as we were recording earlier in the day, there was the FOMC minutes. And even there was really not enough kind of a concern about them sounding hawkish. And so from November 1st until today, we've had weaker NFP. We've had non-existent inflation on the headline as energy continues to kind of ratchet in. Oil prices have been declining. Gasoline prices have been declining for quite some time now, which is a whole other topic altogether. And we had indications on some of the second-tier data like claims, the Philly Fed, and just some ISMs in general coming in weaker, suggesting that the bounce higher in growth in the Q3 has kind of given way to a much more temperate environment. The irony of all this is that, of course, this then suggests, which has been our view all along, the Fed likely is done with the hiking cycle. But as I say, be careful what you wish for. If it's, we're entering into an environment where the risks are now becoming more balanced between the growth outlook as well as inflation now heading towards their target. If growth were to continue to materially weaken as we think it will, then we have to really be concerned about, can the valuations that are now embedded in many of these risk assets, are they sustainable if we're actually heading into a slowdown? Like, this is where I think the market's kind of pulled forward a lot of activity. The broader markets, especially stocks and credit, have really kind of are expecting a Goldilocks scenario. In reality, we might end up with a bumpy, almost hard landing if the Fed does not ease. So this is really builds on this theory that we had of the rates paradox, where the Fed's not going to ease until something actually breaks, and the markets are actually easing for the Fed at this point, unwinding some of this tightening. So I don't think the Fed's going to come into the rescue anytime soon. Meanwhile, the growth outlook doesn't look that great. So I think the markets are getting ahead of themselves.
Totally. I mean, to use an analogy, it's like, you're watching a gymnast and they need to like stick the landing and get like a 10, to win the competition. And unless everything goes perfectly, I feel like, unless absolutely everything goes perfectly, it's really hard to justify some of the valuations that you see in assets, as you just mentioned. So you talk a little bit about this in your upcoming monthly outlook, Macro2Markets publication entitled "Risk On is Whistling Past the Boneyard," or sorry, the Boneyard rather. In that piece, you have two special topics. Let's start with the banking system. That's super interesting. Also your second topic is on deficits. What are you seeing? The banks were obviously a huge topic of conversation, in the first and second quarter of the year, but critical to developments in the economy. So, what are you seeing from banks in terms of lending and overall credit conditions?
Sure, absolutely. So we picked these two topics specifically because these are the both what happens on the banking side as well as what's going in government spending. Those are two major economic actors in the economy, which will give us a sense of where we truly are in the business cycle. And although the banks have no longer been in the headlines like they were during the first half of the year, it's not as if we've seen tremendous progress. And in fact, lending has continued to decline, and credit availability and credit conditions still remain very tight. And so, we looked into this more closely, which obviously those that receive our research can go into it more detail in our piece. But the bottom line for us is that we don't think that we're at a point where with a curve that remains inverted, with rates still elevated, and credit availability deteriorating, that this is really going to cause issues for the small to mid-sized enterprises throughout the U.S., which are largely the creators of job creation, and I think that we're now entering the point where these long and variable lags of both the tightening and the less credit availability are going to start to have a macro implication for the broader economy, and this is where the banks are still super crucial at that sort of development, and we're not seeing any sort of signs where banks are willing to open up the credit box and start to lend. In fact, we're seeing the opposite, and that's I think what will be exposed as we look into 2024, which we'll look into as the year progresses.
Yeah, absolutely. It's a lot to come there. But I really thought the point that you made is that the banks are still kind of constrained here, and lending is declining. And also in some of your charts you quantify non-bank lending. Private credit markets have been getting a lot of play as of late. And I believe, if I'm not mistaken, that stock of credit is also declining. So it'd be interesting to see how that impacts the real economy. Later on this year and early next year. Okay, so that's the banking system. The other piece, the other high point of of your research piece is deficits. So let's talk a little bit more about that. Why don't you give us or rather our listeners, a summary on your thoughts about U.S. deficits and debt sustainably more generally? I mean, the U.S. is running extremely high deficits. The stock of debt is well above, if government debt is well above 100% of GDP. You've got some really eye-opening, charts in the piece. Tell our listeners a little bit more.
Sure, absolutely. And the U.S. fiscal situation has been something we closely follow. Obviously, as fixed income strategists, the outlook for the debt and the deficits are super critical to the rates market. And so we obviously track this closely. And the U.S.'s fiscal situation has been for quite some time on an unsustainable path. And in many ways, we saw a little bit of this year. But even throughout the last decade or so, a lot of times it's focused on generating short-term gains in economic activity without really looking into long-term investments. Although the IRA as well as the other kind of infrastructure plans are trying to get that on a much better trajectory. In general, most of our spending, unfortunately, still is geared towards consumption versus investment. And so I think that this past year, we issued roughly 2 trillion in treasuries. The deficit was roughly about 1.7 trillion, and we are really running crisis level deficits at a time that supposedly we're in an expansion. So what will happen if we ever do fall into a economic slowdown? We're limiting our flexibility on the fiscal side. Doesn't mean we won't resort to it, because I think we will. It just means that we're going to have even higher and higher debt loads, which really then constrains future growth for the nation. So we cover a lot of these topics, really going through what's going on both on the revenue side. There's been a decline in overall revenue the past year, and spending upticks. But it's really an exercise in trying to understand where should that equilibrium be, and running trillion plus deficits doesn't seem like the right number.
Yeah, those are some absolutely huge numbers, and as you said, what happens when if you're spending when you don't need it, what happens? What are you going to do when you need it? All signs point to to that continuing to expand, which obviously has some serious implications for the long end of the curve. Something that you've discussed in recent pieces as well as in this piece. Really
yes,
good.
Exactly. And one more point, I guess, John, just to be clear.
Yeah, sure.
And to kind of wrap that point, which you mentioned about the high debt loads, that's really what got us that initial financial conditions tightening this past summer, and it's come back halfway. But who's to say that it doesn't return? So I think that just because we've had a short-term rates rally doesn't mean that the debt concern has gone away. And in our view, these high debt loads, especially at high rates, we don't think the Fed's going to cut rates back to zero unless there's a real crisis. And so if we're going to be living in a higher rate world with much larger debt stock, that ultimately the fiscal governor becomes the kind of the restriction on economic activity and potential, as the treasury market starts to crowd out the private sector for credit. So I think that's why I think it's super critical. And I don't think it's too soon to say that, and we shouldn't really pass judgment that it's all been resolved because rates have rallied.
Yep, and that's I think we both agree that it's a very dynamic or a very different dynamic that we've sort of been, or in terms of like the dominant dynamic, that's a very different dynamic than we've sort of experienced, let's say, in the pre-COVID period. So really interesting insight. Thanks for all that, George. And I would encourage our listeners to read George's and his team's latest Macro2Markets publication, again entitled "Risk On is Whistling Past the Bond Yard." And I'd like to remind our listeners, if you are not receiving George's strategy reports directly, please do get in contact with him. George, great stuff as always. Thanks for coming on the podcast.
Thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.